Welcome back to our special pre-budget series, Mapping the Stimulus. Before going to the break, our economists told us that they would be okay with a 3.2, 3.3% kind of fiscal deficit. The old Kelkar committee target of 3%, even if not adhered to, will not be taken too badly. But the direction of fiscal deficit getting lower is important for them. As well, they said that revenue growth will likely be in very high single digits, given an about 11.5% nominal GDP growth. Those were the bare numbers that we got from the economists. We now have Dr. Rathin Roy, the Director and CEO of the NIPFP, joining us. Dr. Roy, good morning and thank you very much for joining us. In the first place, everyone's talking about the stimulus, but does the economy need a stimulus in your estimate?
The economy definitely needs to grow faster than it is. The question is, does the economy need a fiscal stimulus, which means more government spending through more government borrowing? Of that, I am not very certain that that is required.
Okay. Now, the psyche from which this argument is emanating is that demonetization delivered a part cash and a part psychic shock to the economy. It derailed a momentum which needs to be pushed back. It's not an argument you're buying at all, or do you think, yes, that happened, but that should be corrected with monetary or non-fiscal stimuli?
I'm not a psychologist, so the psychic shock is not something I can judge. But if there is a temporary fall in the growth rate, then the only thing, the first thing we need to do actually is decide why that temporary fall in the growth rate has happened. Has it happened because people are producing less and there is demand? Or it is happening because people have less cash and therefore there is less demand? In the first case, if people are producing less because of cash flow problems, then the solution obviously is to alleviate those. There's very little you can do in terms of fiscal policy to deal with that. If the problem is a temporary fall in demand, then yes, you could conceivably use fiscal policy to increase demand. The way you would normally do that is to tax people more and then give people money in their pockets to spend. That was indeed the hope, that the increases in tax revenue that would occur next year going forward due to demonetization, that is, an increase in the tax GDP ratio, would provide incremental resources to the government to spend on increasing demand. Because you must remember that demand increases in terms of a short-term shock. You can increase aggregate demand by increasing consumption expenditure. Yes. So you give money to people to spend, and then they spend more on consumption. You can also give money people to spend more by taxing less, but in India, given the small number of personal taxpayers, that is unlikely to stimulate consumption. If you stimulate consumption through increased taxes, I have no problem with that. To increase the tax GDP ratio. But if you wish to stimulate consumption by borrowing more, then I do have a problem with that.
Okay. Well, the fiscal math will also be impacted by the fact that there will have to be a compensation cess and the fact that in the first year itself, the states may not garner much by way of taxes. So, on both sides, you may not get much of a stimulus from the states this time around, since they will be in a period of transition. Therefore, does the central government need to allow its fiscal deficit to go to probably 3.6 or something, run it for a year? That's the argument some people are making.
I do not think so.
Okay. Well, then, in that case, what should the budget deliver at all in terms of growth? What's the 1, 2, 3 things you will look for to call it a good budget?
The 3 things I would look for to call it a good budget would be a clear plan to improve the tax GDP ratio, to simplify corporate taxes, to continue with the process of business process reforms to improve India's doing business indicators, deliver financial sector reforms, deliver tax reforms, and also to manage expenditure more efficiently and effectively on part of the central government. With a revenue deficit, which is essentially borrowing to consume, that is 2/3 of the fiscal deficit, we simply cannot afford a situation where the fiscal deficit rises and rises to essentially finance consumption expenditure. Yes, this year is going to be a volatile year, both in terms of the growth rate and in view of the impending GST reforms coming in. The solution to that volatility is to address it at the moment when it happens, and first to try your best to switch expenditures. GST is a deliberate policy decision of the government. Demonetization is a deliberate policy decision of the government. These are not exogenous shocks. So what government needs to do is fix its fiscal deficit target consistent with its long-term plan for fiscal sustainability and continuing with fiscal consolidation, and then manage its budget within that overall parameter to deal with such shocks that may arise.
Okay.
If you already preempt the shock by saying, oh, it's going to happen, so let's be lax right at the beginning, then you may end up in a situation far worse than you thought might happen, because then laxity will set in. Therefore, I think remaining tough on the fiscal deficit is important. Okay. What the number is will depend entirely on the FRBM committee, which I am a part of, and its recommendations, and whether they're accepted by government or not, which I cannot possibly comment on. Okay.
I have been trying not to make you transgress that line which being in the FRBM panel makes you draw around your statements. But a couple of last quick questions. If the choice is between capital investment and consumption investment, then if the choice is capital investment, are there hurdles in the bandwidth of the government?
It's not a question of bandwidth again there. For example, putting more equity into Air India is also capital investment.
Okay.
Putting money into public sector banks, recapitalizing them, is also capital investment. If the government believes that these things are important and need to be done, then it should make a very clear case on how, having made these investments, such capital investments, will be good for the economy relative to the counterfactual, which is, remember, we are all relying on the same stock of domestic savings, domestic financial savings. More borrowing by government means less financial savings available for the private sector, and at any interest rate, that means a higher cost of capital. So then the argument I've heard is the private sector, for some psychological reason, is not willing to invest. Here I have a problem, because government is not mummy. So if somebody is not willing to invest or somebody is not willing to consume, it doesn't mean that government runs around carrying the can for that. The government must decide what capital expenditure it wants to undertake in terms of its overall strategy for the country, not to compensate for the dilatory behavior, psychological or otherwise, of other economic agents, be they firms or households.
Okay. That's an excellent statement, which I wish one would hear from the finance minister himself. Government is not mummy, and industry can't come crying to the government for consumption or for investment. Dr. Roy, thank you very much indeed for joining us and for kicking off our pre-budget series, Mapping the Fiscal Stimulus, with such strong, solid, clear advice. No case for breaking the fiscal discipline, a path that the government has set for itself and followed so diligently over the past 2 years. And whatever the expenditure, let it be a high productive optimum expenditure which delivers more bang for the buck. That's the message we are getting from Dr. Rathin Roy. Thank you very much for watching our first episode of Mapping the Stimulus. We are coming back with 2 more powerful such series.